good chance you're here because you sell options, in particular puts. What I want to cover today is rolling, because if you're not rolling, you are leaving loads of money, hundreds, thousands, over an entire career, tens of thousands, hundreds of thousands of dollars on the table. Rolling, as someone in my community put it, is your superpower as an option seller, and we often just don't take advantage of it. So remember, of course, this isn't financial advice. This is just what I do. Don't copy us strangers on the internet. Do your own research and make your own decisions. So today, what we're going to cover is the one thing to check before trading sold puts, because I'll just roll it isn't a trade plan. And this part here is what made a huge difference to my trading when I figured out that this is something that I needed to check before I start trading something. We're going to cover where you're losing the most potential, when to roll, because this is really important, why a realized loss isn't a bad thing, and cash in the account is king. Let's jump on into it, starting with busting some myths. So rolling is locking a loss. Now, this is something that came up in my community, the 50K Club, a few times recently. And what members are now saying is, I don't see it as a bad thing anymore, because rolling will show a negative on your P&L, absolutely. But rolling is locking in more cash. We only roll for a credit, remember, we get more cash. It's only a loss in the end if you never end up exiting above your final strike. So forget your realized profit loss and look at cash. Do you have more cash after this roll or less? More cash, you're still winning. Less, something went wrong, right? Caveat over the top of everything we're going to talk about today. The assumption is this is a stock you still want to be in. This is a stock that has upside potential. This isn't a way to fix a bad trade. The only way to fix a bad trade is to get out of it, in my opinion. So rolling is good. Rolling gives you more cash. The other myth is that before you go on into a trade, having the assumption that if it just moves against me, I'll just roll, it'll be fine. And this was a big mistake that I made in the early days, because that's what everyone says, right? Oh, just roll it out. And it seems like something that you can easily do. But not all stocks can be rolled, and not all stocks can be rolled still close in date, right? We find ourselves rolling out for 3, 4, 5, 6 months. That's not a win in my book. So if rolling is your exit plan, you need to check that it's even possible to roll your stock first. So that brings me to, what do we check first? Because not all stocks, as we've said, can be rolled easily. What I call rollability is super important. This is what's going to keep you from that endless rollout to infinity, and will make sure that you can actually get out of this trade eventually. So let's come into the options chain, and I want to show you exactly what I mean by rollability. So let's check if we can roll a stock. Now I'm going to show you two. I'm going to show you Apple, which is notorious for being hard to roll, and one I'm going to show you is actually a full roll that I'm going to walk you through that I've done on Nebius that is far easier to roll. So the first thing we want to do is come to the options chain, and we're looking for the most current expiry, as in the expiry close to us. When we've got multiple expiries, I just choose the Friday. So I'm looking for the current Friday, which is 8/28, and I want to find my puts, and I'm going for a put that is just in the money. So let's have a look at this 315. So assuming our 315 put has just been breached, we want to roll it. To buy that back, it'll cost us $6. So we're going to be negative $6. Rolling it means we're going to sell one into the future. To roll for a credit, which is all we ever want to do, we need to find something that we can sell that's a lower strike for more than $6. So let's go out to the next week. So the next week will be 9/4, the next Friday. We're looking for something lower than 315, and higher than $6.38. And look at this, we can't get it. We can't roll by just 1 week. Rolling to 1 week is only going to get us the same strike. But more often than not, if you're rolling, it's because you need or want a lower strike. So let's count another week. 9/11 will be the next Friday. Okay, so on 9/11, we can get down to the 312.50 for $7.80. So that'll give us a small credit. We may be able to get the 310 if we're lucky with the spreads on either contract, the one we're buying and the one we're selling, but it would be for break even, not credit. So Apple, we can look to go out potentially if we had to roll 2 weeks for $2.50 worth of a reduction in strike. Now, to me, this would mean that my exit plan on Apple will not be roll, right? I'm not selling a put on Apple with the assumption that I can roll it because I kind of can't, right? The exact same scenario on Nebius. So I'm in the current expiry, 8/28. I'm looking for a put that's just gone in the money. So let's choose this 230. I'm just going to write it down, 230. If we had to buy that back today to close it, that's going to cost us $12.55. Let's go on the hunt for something greater than $12.55 with a lower strike. And look at this. We can go all the way from 230 down to, at least if we wanted a teeny tiny credit, 220. So we can drop our strike by $10 and go out only another week, right? What if we wanted to go out 2 weeks? So we're looking for $12.55. We'd be able to come down potentially all the way to 215, if not maybe to 12.50 from 230. So this to me is really, really rollable. This means that if my plan is I'll roll it, I can do it, right? So this is always the first thing that I'm looking for. I do it on calls as well. I've got a different video where I show rolling calls, but for sold puts, this is the first thing that you want to look at. Okay, so now we've established that we are about to trade something that our exit plan potentially can be, I'll roll it down. Now, there's 2 ways to exit the trade, right? Either the stock runs all the way up or it drops down. So let's take a look at your biggest losing potential, which is when the stock runs up and we just do nothing, right? If you're not following the stock up and you're just letting your contract expire worthless or you're closing for a percentage of profit, this is where you're leaving significant money on the table. Let me show you exactly what I mean. Now, I'm going to show you in the charts as well so you can see exactly what this looks like. Remember my dates, my transaction dates. I'm in Australia, I live in the future. If you go searching these dates to line up with the actual chart, it won't work because my dates are a day in the future, right? So here's what happened. June the 2nd, I opened a Nebius contract at a 195 put and I received $564. Yay for me. The stock ran up. So rather than just letting that expire and collecting my 564, I rolled the contract up, kept the same date. I didn't need more time, but because we'd had this significant run, my 195 is no longer likely to be breached. So why would I not want some more money for this trade? So I rolled from 195 up to 220, right? I bought back my 195 for 107 and I sold the 220 for 237. So that gave me an extra $130 worth of profit in this trade that ultimately I closed on. Remember, it says June 27 for me, but that would have actually been June 26 on expiry date. So I turned $564 profit into 564 plus 130 purely by rolling it, right? Let's have a look at the chart. So I originally had my strike all the way down here, 195, and we'd had this massive run up. So June 26th was this day here, and we closed that day at what, 240. So I, through this run up, rolled my strike up to 220, right? Still a decent distance from where we ended. I was still happy with that. And this is the next part that we're about to look at. I knew that I could still roll it back down and extend my time if I needed to, right? So one thing as well that I want to share is that when a stock runs up on you, what I used to do at least was I'd exit and I'd go looking for another stock. But now what I've learned is trading the same stock over and over and over and over and over again. It's actually better and more profitable, for me at least, than hunting for new opportunities all of the time, because you get to know the stock, you get to know the chart, you get to know how you can roll, when you should roll, all of that sort of stuff. So that then poses the question, when do you actually roll up? Because we don't want to do it all of the time, because we don't want our stock to, come back down and then breach the new strike where the original one would have been just fine. So I like to look at rolling up when I'm confident that the strike I roll up to won't be breached, or at least I'll be able to roll down and out. Now, I'm not doing this if there is still substantial time left on the contract necessarily, unless we've had a huge run. I'm looking to do this when there's a week, there's 2 weeks maybe, but not if I've got 3-4 weeks. I'm mostly at the moment in the market anyway, only selling puts kind of 2 weeks out because we're in this sort of choppy market. So I like to be able to keep my strikes close because then I maintain more control over the trade. Now, that's rolling up. What if we're just rolling all the way around? We're up, we're down, we're up, we're down, right? So what I want to show you here is some movements I made, again, on Nebius, where I went from, and you can see all the transactions here. I've put the transactions in here this time because there's always people in my comments saying, you just made that up. No. So on July 1st, I sold the 220 put for the 24th of July and I received 990. What happened? That looked like we were getting breached, or maybe it did get breached. Most likely did get breached. So I closed that contract and I rolled it down to a 210. Now, I want to talk in a moment about this big negative number because this is where people freak out. They're like, you're losing. No. The reason why is because what I bought back, I paid $29.85 for. What I rolled to, I received $32.07 for. So for getting this number, I'm ahead by making this roll by $222, right? What happened? We dropped down a little further. So I then rolled from 210 to 200 and I received more credit. Why? Because what I bought back for, I paid $15. What I sold, I paid $20 for. To me, that's a good roll, right? Now, yes, all of this ended up taking me over earnings, which I usually don't trade over earnings. But sometimes when you're rolling, you just end up in the trade over earnings. That's a decision that you need to make if you're happy to be in there or not, right? Then what happened? I went from 200, and this is on earnings. Nebius had a huge bounce on earnings. Now, I could have just gone $200 put, thank you very much, I am safe, I am fine, and let it go. But with a huge run up, and there wasn't long to go, there was literally a day before expiration, or 2 days, why would I not roll it up and get some more credit? So I did. I rolled it up, got some more credit, and then ended up closing that position on expiry date. Just like that, right? Let me put this into a more easy to follow spreadsheet because these numbers here aren't all real. Add them up, they come out in the wash. But to me, I don't like to follow this because it doesn't give me a good idea of where I'm at. So instead, hang on, let's not go to that one yet. Let's come to my spreadsheet. All right, so instead, I just track things by credit I receive, right? So on the July 1st, I opened the contract, I received $990. When I rolled it down to 210, I received another 222. Yes, that shows my realized loss as 1996, but the cash I have in my account is the 990 plus this extra 222. I've not lost money, right? There is more cash in my account after making this trade than there was before. I have not lost a single cent. I then rolled it down again and I got myself another $450 credit. This is the part that trips up a lot of people. Whenever I say I roll and it's by a substantial amount, like $10, by not a substantial time, 1 week, people freak out at this amount of credit. And it's because it's a rollable stock. It's because I've checked that beforehand. You won't be able to do something like this on a stock like Apple. We've just seen that, right? Then I rolled up, kept the same expiry, rolled up to 220 for another 85, and then I closed it out in the end, and that was a debit because I did resell it, but for the sake of what we're tracking here, I just closed that contract. It cost me $15. All up, this trade profited me $1,732. I am very happy with that. To me, this is a successful trade, and that's the rolling that helped me achieve that. Now, could I have taken assignment at any of these prices? Absolutely. And in a different account, maybe I would have, but the account that I had this in, this was on margin, and I often like to just roll puts on margin because technically I haven't borrowed any money, therefore I'm not paying any interest until I'm paying a borrowing fee, which is a teeny drop in the ocean worth of interest against margin. So I'm not paying to hold the shares. I'm just continuing to collect extra credit on quote unquote borrowed money, right? Now, the next thing that I did on this trade was reopen it. So the Friday was here, 14th of August. We were still trading nice and high. So I opened a 1-week contract for the 21st, which was this date here, at 220. And we closed just below. Again, I could have taken assignment in this particular account, though I didn't want to. So what did I do? I rolled it, right? And I received more credit. So let me show you the exact transactions on that and where I'm at. Actually, I'll show you where I'm at now. I'm at 210. 210, expiring this week. So if we get a huge run up like this, then I can roll it back up. If we drop down below 210, I can roll it back down. So these are those transactions. I've blacked this out only because it was my closing transaction that you guys just saw before. Don't mind the cat tail. So the opening transaction, I sold my 220 for $384. Again, cash. We're just stacking cash. It gets breached. What do? I roll it to 210 for the following week. Again, forget the negative. The negative isn't important. Why? Because what I sold, I received $903 for, which is more than what I bought for at $793. And again, I track it all in here. My opening transaction received $384. My rolling transaction received an extra $110. Realized loss, we just saw of $410, but I don't care because the cash in my account is $494. I've not lost money. Okay. Now, when we roll is really important because the final piece of this puzzle is that you can't get big credits like this if you're rolling at the wrong time. So let's check that part out. So rolling down, when I like to do it, essentially when the stock breaches your sold strike. Why? Is because you'll get a better roll when you're basically at the money. I'll show you the contracts again in bar chart so you can see exactly what I mean. It's kind of mind-blowing how this works. And the other part is when we're adding extra time onto the contract, in my opinion, it's adding more risk, not lower risk. So I'm always trying to keep my DTEs, should I say, within 30 for easier management. So I'm not looking to roll out for another 30 days or another 40 days or 60 days or to the end of the year or anything like that. I'm always still trying to keep my DTE within 30 so that the strike doesn't have to go as far in the money when it's still out in time. The easiest roll you'll get is when we're within usually 7 to 14 days and we've only just gone in the money. Okay, let's take a look at that final piece. So we're back here again looking at Nebius on 8/28 expiry. We saw how easy this was to roll if we'd just gone in the money. Let's pretend though that we waited it out, which is what a lot of advice often is, right? You've still got plenty of time on the contract, just wait, the stock might come back. But if the stock keeps going down, your ability to manage the trade is less and less and less by every dollar that the stock drops. Let's say we let this go out to, whoops, where did I just land myself? Nowhere. 8/28 puts, let's say our strike is far in the money, our strike is 260. That's the one we need to buy back. Well, let me write this down. So we're buying back our 260 strike, and that's going to cost us $39.18. Let's go into the future and see how low we can roll this for something that we're going to receive at least that same amount for. So if we're coming up, let's go out a week. We're looking for 39. Look at this. We can't even get the $5 drop. We can get a $2.50 drop, but we can't even get 5 yet, right? Let's go out another week. 9/11. We're looking for 39.18. We can get our 5, but we can't get 10. And remember, our strikes that were really close to the money, we could roll very, very easily. We were able to get a $10 roll down and still get a credit. Here, we're barely able to get 5. So it's so important, in my view at least, to roll sooner than you think you need to if your goal is to just reduce the strike, reduce the strike, reduce the strike. If you want the strike lower, then you want to roll sooner rather than later. Okay, and one final myth that I want to cover off is when people say that rolling is giving away your theta. You're just giving it away. You're better off waiting until closer to expiry. Well, we've just seen why you don't want to wait until closer to expiry, because the further in the money you strike, the harder to roll. But I took this, like when I first heard it, I was like, okay, yeah, that makes sense. But then I got thinking, I was like, well, where's the theta going, right? It's not going anywhere. Because if I've got a week from today until expiry, that 7 DTE still exists even on a new contract, right? The time doesn't disappear. It's still there. Yes, I bought back though the theta on that 7 DTE, but I resold it when I sold my new 14 DTE. So that's something as well that people say that just didn't make a lot of sense to me. And when things don't make sense, I always say, become a 2-year-old and ask why. And to me, that didn't make sense. So I hope this was helpful. I hope it's kind of opened your mind as to how rolling can be your superpower in options, when you might want to roll, why rolling sooner is usually better, and how to check the trade and the exit plan of the trade before you get into it. That to me is really, really important. So if you've found all this helpful, I'd love to invite you into the 50K Club. This is my community for options traders where we just create consistent monthly income without needing a 7-figure account. So if what I've shared with you is of interest, the link for the 50K Club is in the description. I would love to see you in there.